Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
After listening to today's news, you'll know first, US 50% tariff on India sparks a 40% export plunge, threatening the rupee and stoking US inflation. So we'll discuss why this tariff battle tests a key strategic partnership and what it means for US inflation and the Indian rupee's stability. Second, US pressure scuttles a 10-year global shipping deal, freezing trillions in green investment and risking supply chain chaos. We'll analyse why this failure shifts the burden to regional rules like the EU's and how it could create a new wave of greenflation. Third, India's $3.8 trillion gold hoard fuels an investment rush as demand shifts from jewellery to ETFs amid a central bank de-dollarization push. In this episode, we'll break down this financialization of savings and what it signals for global gold price volatility and the de-dollarization trend. Washington just hit India with a staggering 50% tariff, and the fallout is immediate. This isn't just a trade dispute. A full 25% of that tariff is a direct penalty for India's refusal to stop buying Russian oil. You know, this move is more than just a trade spat. It's a major test of the US-India strategic partnership. Washington is using economic pressure to try and influence India's foreign policy. The core issue is that if this economic coercion becomes too painful, it could inadvertently push India closer to alternative blocs like BRICS, which includes both Russia and China. This is a high-stakes geopolitical chess game playing out through trade. The result? India's exports to the US, its single largest foreign market, have cratered, plunging nearly 40% in the last 4 months alone. Shipments have plummeted from $8.8 billion in May to just $5.5 billion in September. Research confirms this sharp decline is unprecedented in the past decade, highlighting just how severe these new tensions are. According to one think tank, the US has now become India's most severely affected market. This is where the situation takes a more complex turn. While these tariffs were taking effect, former President Trump stated that Indian Prime Minister Narendra Modi had agreed to halt Russian oil purchases. India's foreign ministry, however, painted a different picture, stating only that discussions were ongoing. This mismatch reveals a high-stakes tension point right in the middle of active trade negotiations. The economic pain is already spreading. The tariffs are hitting India's most labour-intensive sectors the hardest, with textiles, gems, and jewellery all suffering heavy losses. And this pain doesn't stop at India's border. These tariffs on labour-intensive goods like textiles and jewellery will almost certainly translate into higher prices for American consumers, directly testing the trade-off between protectionist policy and the fight against inflation. Recent data already shows the US Consumer Price Index for apparel rising faster than expected, and these tariffs are likely to add more fuel to that fire. This has directly contributed to India's trade deficit widening to a 13-month high of over $32 billion. That's a big deal because a widening trade deficit puts significant downward pressure on a country's currency. In this case, the Indian rupee is at risk. This forces the Reserve Bank of India into a classic economic dilemma. Should it spend its valuable foreign reserves to defend the rupee's value, or should it let the currency weaken and risk higher inflation on imported goods? Either choice could slow India's growth. All of this is happening as the two nations are trying to finalise a trade deal. For years, the US was India's biggest trading partner, and both sides had set an ambitious target to more than double their bilateral trade to $500 billion. Now, that goal is facing its greatest challenge as a key economic partnership is being severely tested. Interestingly enough, this friction creates an unintended strategic opening for other countries. For Chinese businesses, this could be a paradoxical windfall as the US market becomes harder for India to access. Chinese exporters may find opportunities to fill that gap. At the same time, China remains a massive market for India. In fact, India's trade deficit with China has already hit a record high of nearly $100 billion, driven by imports of electronics and machinery. This complex dynamic shows how US protectionist policies can have unintended consequences that benefit the very rivals they are meant to contain. So looking ahead, the immediate focus will be on the Indian rupee's exchange rate and the Reserve Bank of India's policy response. We should also monitor US inflation data, especially for core goods like apparel, to see the direct cost to consumers. Finally, it's worth keeping an eye on trade data from other manufacturing hubs like Vietnam and Mexico. This US-India dispute is accelerating a global supply chain reshuffle, creating new winners and losers much faster than anyone anticipated. Speaking of high-stakes economic pressure, Washington's influence was felt in another major international arena, where a landmark global deal, 10 years in the making and backed by over 100 countries, has just been abandoned at the 11th hour. This was supposed to be historic. The agreement would have made the global shipping industry, which transports 90% of all goods, the first sector in the world with internationally mandated targets to cut emissions. The plan was agreed upon in April and countries were gathered in London for the final vote. But on the final day, it all came crashing down. The collapse followed intense pressure from the United States, with former President Donald Trump posting that the US would not stand for what he called a global green new scam tax on shipping. From a political strategy perspective, the framing of this was everything. The power of calling a climate policy a tax is that it shifts the focus from the polluter pays principle to a narrative about direct costs for consumers. This tactic has proven very effective and suggests that future green initiatives will face major political headwinds globally. Reports indicate his administration threatened countries with tariffs if they voted in favour of the deal. Now, get this. This kind of action has a ripple effect that goes far beyond this one agreement. The successful use of tariff threats to scuttle an international deal signals a renewed America First doctrine. This undermines multilateral institutions and creates deep uncertainty. For global businesses, this uncertainty translates into a higher geopolitical risk premium, which can make companies hesitate to invest and can slow down the flow of global commerce. In a dramatic conclusion, Saudi Arabia, backed by the US and Russia, tabled a motion to adjourn the talks for a year. The chairman confirmed this move effectively scuttled the entire agreement. The motion passed by just a handful of votes. The fallout was immediate. The International Chamber of Shipping expressed its disappointment, stating the industry needs clarity to make critical investments. The industry's need for a single global set of rules really comes down to money and investment on a massive scale. Without a clear, predictable standard, a multi-trillion-dollar investment cycle in green shipping is now essentially frozen. Ship owners won't risk ordering expensive new vessels if they don't know what the rules will be in 5 or 10 years. This regulatory chaos could create a lost decade for decarbonisation. Environmental groups and nations like Vanuatu voiced outrage, with its climate minister calling the move unacceptable given the urgency we face. The impact of this failure is significant. Shipping currently accounts for 3% of global emissions, but it's not just about the environment. This could end up affecting the price of things you buy. Actually, the collapse of a single global standard doesn't mean there will be no rules. Instead, it will force a shift to a fragmented patchwork of regional regulations, like the European Union's emissions trading system. For companies, navigating dozens of different regional rules is far more complex and expensive, introducing a new sticky source of supply-side inflation for all the goods that travel on these ships. Without this intervention, the International Maritime Organization had previously estimated that by 2050, those emissions could skyrocket by as much as 150%. The collapse reveals a major fracture in global cooperation. With the carefully planned timeline for 2028 regulations now unfeasible, years of work have been reverted, leaving the future of global shipping emissions in complete uncertainty. So where does this leave us? The key things to monitor now are how regions like the EU push forward with their own rules and whether other countries follow suit. We should also watch major shipping companies' capital expenditure plans to see if the investment freeze continues. Finally, keep an eye on freight rate indices like the Baltic Dry Index. A sustained rise could be the first sign of this new greenflation hitting global supply chains. With all that uncertainty swirling around global trade, it's no surprise that investors are looking for safe havens. That brings us to our next story, a full-blown gold rush in India, but with a twist. Gold prices have skyrocketed 60%, with silver up 70%. But in India, the world's second largest gold market, instead of a retreat, it's a gold rush. Jewellers on the ground report that a powerful fear of missing out is driving a record number of customers who worry prices will climb even higher. But with budgets stagnant, the market is undergoing a radical transformation. The focus is no longer on elaborate jewellery. Instead, consumers are snapping up lighter pieces and, more significantly, investment-grade assets like coins and bars. Retailers are now selling gold coins as small as 25 milligrams just to meet the demand. Believe it or not, this trend toward lighter jewellery is a classic case of what economists call shrinkflation. It's the same idea as when a bag of chips has more air and fewer chips for the same price. In jewellery, this means crafting pieces that look large but use less gold. It's a subtle but important signal that while the desire to own gold remains strong, the average consumer's budget is under significant stress. We recently focused on record global inflows into gold ETFs. Today, that behaviour is clearly being mirrored in India. The data is seismic. According to the World Gold Council, the share of gold demand from investment has exploded from 19% to 35% in just 1 year, while jewellery's share plummeted from 80% down to 64%. This shift is also happening digitally, with assets in gold ETFs surging by over 70% this year alone. This shift from physical jewellery to financial products signals a profound financialization of savings in India. The implications are huge because gold demand there is becoming less about cultural traditions and more about reacting to financial market signals, much like stock investors. This could make global gold prices more volatile, linking them more closely to global risk-on and risk-off sentiment. And it's not just small investors. The Reserve Bank of India has become a major force in global gold demand, strategically increasing its holdings to diversify away from the US dollar. We're seeing India's central bank stepping up its buying, while at the same time, China's central bank, the PBOC, has also been on a major gold buying spree. This collective action from the world's central banks creates a huge, consistent demand for gold, providing a strong floor for prices and signaling a long-term structural shift away from US dollar-denominated assets. The most jaw-dropping number today reveals how this plays out at the household level. According to investment bank Morgan Stanley, Indian households now hold a stunning $3.8 trillion in gold, an amount equivalent to 88.8% of the country's entire GDP. This massive surge in the value of household gold is creating what economists call a positive wealth effect. Even if people's incomes aren't rising, the fact that their gold holdings are suddenly worth so much more makes them feel wealthier and more confident to spend. This hidden strength on household balance sheets could make the Indian consumer far more resilient than traditional economic models suggest. It's not just a story about a precious metal, but a story about the changing foundations of a major global economy.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.